Welcome back. This is Business 353, Volume 1 of the Wiley text by Kieso, and we are referring to investments in this chapter, Chapter 9, dealing with investments. So, our learning objectives are listed here. The main concepts covered in this chapter are the different types of financial and asset investments in basic equity and debt instruments, and the various models used to account for them. The material covers investments held for short-term profit as well as longer-term investments held for strategic purposes that give the holder significant influence or control. The chapter focuses on the recent changes required by international standards. The accounting standards brought about by these changes were intended to address the deficiencies of the historical cost method of accounting for investments, but the fair value measurements that resulted were complicated. So this chapter focuses on the basic accounting models used to account for investments in debt and equity securities in general, and which underlie current initiatives. So we'll talk about significant investments. Those are entities which for which the parent company doesn't have control, but it has a significant amount of investment. So it has the ability to influence the timing of dividend payments and other payments between the companies, and so we account for that using a method called the equity method. We'll talk about the model of accounting for investments using historical cost, or an amortized cost model. Of course, that isn't inclusive of the potential returns on the investment, and so that's a bit problematic. Look at the fair value through net income model of accounting for investments, and then the fair value through other comprehensive income model. So fair value through net income means that you actually record the gains and losses on value changes in your underlying investments and run them actually through the net income number. Fair value through other comprehensive income, of course, relegates those changes in value. The unrealized changes in value would be recorded as part of the other comprehensive income at the bottom of the income statement. We'll talk about incurred loss, expected loss, and fair value loss impairment models, and talk about the equity method, as we mentioned before, for category 1. We'll talk about the idea of control. Control may mean more than 50% ownership, but it might be exercised using a number of different strategies or different ways of asserting control. And so in the case of control, the company has control of all the assets and liabilities of the subsidiary company, and they owe the minority investors in that subsidiary company their share of the income, but they're in control of all the assets and resources. So they would consolidate all of those assets and resources with the parent company's resources. That's actually the subject of Business 401, which is our advanced financial accounting course here at King's. And so points 1, 6, and 7, and 2 to some extent, are all covered in that course. We'll talk about presentation and disclosure, difference between IFRS and ASPE, and what's coming along in changes expected in the future for these investment categories. So this slide shows the relevant sections of both the ASPE standards in this column and the international standards in this column. There are a number of different standards which refer to the topics covered in this course. Business combinations is a significant part of the Business 401 curriculum, as is non-controlling interest and consolidated financial statements, as is investment in associates. Financial instruments recognition and measurement, and presentation and disclosure are essentially this chapter in the intermediate course, but the first 4 topics will be more covered in more detail in Business 401. So our strategy for going through the discussion today is shown here, starting with different kinds of investments and talking about the types of companies that have investments in other companies, information for decision making, which of course is the reason we have accounting information in general. We'll talk about cost and measuring investments through cost or amortized cost, fair value through net income, through fair value through other comprehensive income, and impairment. So value is impaired for some reason, we would write down the value of the asset and record the loss in our financial statements. Strategic investments in associates and subsidiaries. Associates, excuse me, associates would be companies where you have significant influence but not control, and so you account for those using the equity method. Subsidiaries are companies which are controlled by the parent company and as such are consolidated with the books of the parent company in presenting consolidated financial statements. Both of those are topics that we cover in detail in 401, the Advanced Financial Accounting course. Then we'll talk about presentation disclosure, analysis measures, the comparison of IFRS and ASPE, and looking ahead for future standards. So let's begin by talking about the type of investments. A financial asset is defined as being any asset that is either cash or an equity instrument of another entity, so shares in another company, or a contractual right to receive cash or another financial asset from another party, or the right to exchange financial assets or liabilities with another party under conditions that are potentially favorable to the entity doing the disclosure. So if you've got a deal where you can exchange financial assets or liabilities to the advantage of your company, that is a financial asset. The International Accounting Standards Board requires companies to classify financial assets into two measurement categories, either amortized cost or fair value, depending on the circumstances. Now, debt instruments represent a creditor relationship with an enterprise. They include debt instruments such as investments in government securities, municipal securities, corporate bonds, convertible debt, and commercial paper, which is very short-term lending agreements, usually with another financial institution. Equity instruments, on the other hand, represent an ownership interest, so it would include common shares, preferred shares, or any other capital stock or shares in another company. It's any contract that is evidence of a residual interest in the assets of an entity after deducting all its liabilities. A company will invest in debt and equity instruments issued by other companies to make a return, such as interest, dividends, or capital appreciation, capital gains, on excess cash not needed for other purposes. The investment may be intended to generate short-term or long-term returns, depending on the company's goals and the need for the excess cash. This type of investment is referred to as a non-strategic or passive investment, where you're not actually active in managing the other company, but you're expected to receive a return from them. A company may also invest for strategic reasons, and strategic investments are entered into to give the investing company, the investor, significant influence or control over the operating, investing, or financing decisions of the company in which it has invested. And that company, of course, is called the investee. So the investor invests for strategic reasons in the investee. Now, accounting for the investments depends on the type of instrument, whether it's debt or equity, for example, management's intent, the ability to reliably measure the fair value of those instruments, or the extent to which a company can influence the activities of the investee company. So accounting for initial investments requires them to be measured on acquisition at the fair value, which is generally the price paid. The transaction costs are added to the acquisition cost, like they are to any other asset, if the cost or amortized cost method is used, and they're expensed if the fair value method is used. Subsequent to acquisition, the change in the fair value carrying amount of the financial instruments is called unrealized holding gains or losses. So after the date of acquisition, any new investments in the firm would be included in that amount. So the change in the fair value carrying amount of financial instruments is measured at fair value and are called unrealized holding gains and losses. These gains and losses are usually identified separately on the financial statements. There are three main accounting models used for the various non-strategic debt and equity investments. So they include the ones listed here: cost amortized, fair value through net income, fair value through other comprehensive income. The cost amortized cost model measures the cost at acquisition, which is equal to the fair value plus any transaction costs. And at each reporting date, you continue to measure it at cost or amortized cost. So if it has a limited life, of course, it would be amortized cost. If it doesn't have a limited life, it would be measured at cost and usually would be subject to an impairment test. Unrealized holding gains or losses are not applicable. Only realized holding gains and losses are reported, and they're reported in net income. Fair value through net income are measured at fair value on acquisition, so transaction costs are expensed. At each reporting date, they're remeasured at fair value, so kind of mark to market is the term that's commonly used for that. And unrealized holding gains or losses are reported in net income, and realized holding gains and losses are reported in net income. So changes in value as well as actually money that's actually been received. So dividend income, for example, would be included in net income, and the capital gains for a change in value of the shares would also be included in net income. Fair value through other comprehensive income is measured at fair value on acquisition, so once again transaction costs would be expensed, and at each reporting date it's remeasured at fair value, so it's marked to market as well. Unrealized holding gains or losses are reported in other comprehensive income, sort of below the line of net income on the income statement. Realized holding gains and losses are transferred to net income, which we call recycling. So when you've actually received the cash, the amount of gain represented would be recorded in net income because it has been realized. Or it could be posted directly to retained earnings, which is without recycling. So recycling means it goes into net income and then falls into retained earnings. Without recycling means it's posted directly to retained earnings without going through the income statement. We used to refer to that as clean surplus for the recycling and dirty surplus for the without recycling part. Cost and amortized cost. This model is applicable to both debt and equity instruments. However, as shares are not amortized, the term cost is applicable for investments in equity instruments, and the amortized cost model applies only to investments in debt instruments, such as long-term notes, loans receivable. Application of the cost model for an equity investment is as follows. The cost of the investment is equal to the fair value of the shares acquired, or the fair value of what was given up to acquire them, if that's a more reliable measure. So that depends often on the liquidity of the market for the shares. If it's traded on a public market, and it's a fairly active trading market, then you would use that value because that's an objective value of the shares. If not, you might record the fair value of what was given up in deference to the stated fair value of the shares. But it depends on the reliability of the market value that you would be using. So the cost of the investment is equal to the fair value plus any direct transaction costs, such as commissions paid, any costs that are incurred to acquire the shares. And unless the asset value is impaired, the investment is reported as its cost in each statement of financial position date, its balance sheet date. We would recognize dividend income when the entity has a claim to the dividend, so when it's been declared by the board of directors of the invested company. When the shares are disposed of, you would de-recognize them and report a gain or loss on disposal, and that gain or loss would be recorded in net income. Gain or loss is the difference between the investment's carrying amount and the net proceeds on disposal. The application of the cost model to debt investments would be somewhat different. The cost of the investment would be equal to the fair value of the debt instrument acquired, or the fair value of what was given up if it's a more reliable measure, plus again any transaction costs such as commissions which are incurred to acquire the investment. And unless that debt investment is impaired, the investment would be reported at its amortized cost plus any outstanding interest receivable at each balance sheet date. You would recognize interest income as it's earned, because presumably it's just the time passing that gives you the right to receive interest income. It doesn't have to be declared as dividends do. So you record the interest income as it's earned, amortizing any premium or discount at the same time by adjusting the carrying amount of the investment. And when the investment is disposed of, you would first bring the accrued interest and discount or premium amortization up to date so that you have it properly valued at the time of the transaction. Then you would de-recognize the investment, report any gain or loss on disposal in net income, and the gain or loss once again is the difference between the investment's amortized cost at the date of disposal and the proceeds received for the security. Now IFRS requires that the bond premium or discount use the effective interest method, so you would actually have to use your time value of money buttons on your financial calculator to determine that. ASPE allows a straight line amortization method, so you would calculate the premium or discount at the date of the purchase of the investment and then simply amortize it over the period of the asset's life. So in practice, the discount or premium on bond investment is not usually recognized and reported separately, although it could be, so it would just be added to the value the investment. Back in the old days, we used to have to calculate the premium and discount separately, and we would track it over time and adjust the value to interest income or interest, well, either an increase or decrease in the interest income received. And that's basically the ASPE method. The IFRS method means you actually have to calculate the present value of future cash flows and record the accretion of the discount as interest paid over time. We learned how to do that last chapter. All right, so I guess we should have moved on to the debt securities the slide when we were talking about the debt a moment ago. So if you like, go back and take a look at that, or listen to the previous discussion for debt securities. Moving along then, here's an example using the amortized cost model. The face amount of a bond being $100,000, the purchase date January the 1st, 2017, with a maturity January the 1st, 2033, which is 16 years later. The interest is paid twice a year, July 1st and January the 1st. The coupon is 8%, so on $100,000, that of course would be $8,000. The market rate of interest is 10%, so this bond is paying us less than the market rate of interest. It's going to be a discount bond. So what is the approximate purchase price? You can calculate using this the information below, and of course if you calculate it based on your financial calculator values, the face value would be $100,000. That would be the future value. The $8,000 of interest would go in the payment category. The 10%, well actually just a second here, the $8,000 is paid twice per year, so we need to actually divide that by 2 and put $4,000 in the payment category. And the 10% effective rate of interest would be 5% per semi-annual period, so put in 5 as your I per Y. We've got 16 years, and we need the number of semi-annual periods because the rule is N, I per Y, and payment all have to have the same period, and it's a semi-annual period in this case. So 32 would be the N. We compute our present value. I get a different number. Just a second. I think what happened here is that there's actually a typo. I think this should say 2023 because they're talking about, well, this N is 10 because it's 10 semi-annual periods. So if we put in 10 as our N, as it suggests there, and compute the present value, we get 92,278. So N is equal to 10. There's a typo. This should actually say January 1st, 2023, and then it makes some sense. All right, so that's the cost calculation. So then we move on to the next slide. And the entry to record the purchase is investment in bonds as an asset goes up by 92,278. Cash goes down by 92,278. And the discount of 77.22 is just used to reduce the face value of the bond to the investment cost of 92,278. The effective interest method would mean that as we get closer and closer to the maturity date of the bond, which is 2023, January 1st, 2023, we would increase the investment in the bonds and record the change in value as interest being received on the bond. ASPE allows us to use a straight line method of amortizing the premium or discount, in which case we would take the 77.22, this discount, and we would amortize it over the 5 years of life of the bond. So we would be presumably reducing the dividend, and so bringing the asset up in value. We're increasing the asset value, so that's going to be a debit to the asset. We'll be crediting the interest expense, or the interest revenue in this case, because we own the bond, so we paid for it. It's our investment. So the money coming in from the bond would be interest being earned. Okay, so the bond amortization looks like this. you could do that calculation if you like. We're going to receive the coupon payment in each of those periods, and so you can see that the end of the life is going to be, well, here we have it's the 22nd. Okay, so, alright, so I was wrong. 17 plus 5 is only 22, so 122. So still same story. It is a typo. It's just I had the wrong number of years. Anyway, this is the amortization schedule, and so that's based on 10 semi-annual periods as listed here. The amount of the interest income is going to be based on the amortized cost of the bond, so 92,278 at 5% gives us 4614, which is what's shown down here. And 614, of course, is the unpaid interest income, so we add that to the principal of the bond. The bond value goes up to 92,892, and so on as we continue our way through. At the very end, the amortized cost of the bond goes $100,000. We record this column as the interest income amount based on the 10% market rate of return that we agreed to at the time of the purchase of the bond. So the balance sheet would include a current asset or interest receivable, any accrued interest which hadn't been repaid yet, and since we're receiving the coupon on the 1st of January, pretty much the entire coupon would be receivable at the end of the year. And the long-term investments would be recorded at the investment at amortized cost, which is the cost adjusted for either the effective interest method or for the amortization of discounted premium in the ASPE method. The income statement would show gains on, well, the interest income amount would be shown on the income statement. When we sell the investments, the discount is deducted from the face value of the bond if they're shown separately, or we already have the bond recorded at its carrying value. Of course, we need to update that to the time when we actually make the adjustment, so we need to calculate the effective interest so that we're separating interest income properly from the capital gain or loss on the sale of the bond. And the new carrying amount that we calculate would be used to calculate the gain or loss, and the gain or loss would be included in the income. Any accrued interest income is calculated over and above the selling price of the investment, so that's the purpose for doing the recalculation of the carrying amount, so that we have the interest income properly recorded as interest income and the nature of the income is properly recorded. So that was the cost or amortized cost model. Now we're looking at the fair value through net income model. Fair value through net income means that changes in the value of the investment would be recorded in net income, sort of above the line, as opposed to recorded in other comprehensive income. Whether they're realized or not, they both get recorded in net income under this model. Under the fair value of the comprehensive income, the unrealized changes in value would be recorded as other comprehensive income. The fair value through net income model is applicable to both debt and equity investments, and this model is also referred to as fair value through profit and loss in the international standards, so you might see it referred to in either way. Application of the fair value net income model is as follows. The measurement at acquisition is the fair value of the investment acquired, or fair value of what was given up if it's more reliable, and transaction costs are expensed immediately. The carrying amount of each fair value through net income investment is adjusted to its fair value at each reporting date, with all the resulting unrealized holding gains and losses reported in net income, along with any dividends or interest income earned. For value through net income investments held for trading purposes, those are the ones held to sell in the near term or to generate a profit from short-term fluctuations in price. Both the interest and dividend income need not be reported separately from the holding gains or losses, but you can account for them and report them together to mirror how the investments are managed, so it doesn't really matter. All of the cash flows from the short-term held for trading investments would be recorded as income from the trading. When the entity holding the investment needs or wants to track the holding gains and losses separately, then the dividend would be recognized in accounts such as dividend income. The adjustment to fair value at each reporting date would be recognized as a separate account, such as gain or loss on fair value net income investment in shares or debt, as the case may be. For debt investments, separate reporting is more complex because the recognition of the interest income separately requires that the discount or premium be amortized over the change before the change in fair value is recognized. The amortization of the discount or premium changes the investor's. Sorry, let's try that again. The amortization of the discount or premium changes the investment's carrying amount. So the fair value adjustment entry has to take into account that change in value, the change in the carrying amount. There are several ways the bookkeeping for this can be handled, but the text takes the approach that maintains the investment account at fair value, and the necessary amortized cost information is kept in supplementary records. So the steps would be as follows. We would recognize the interest as interest income on the fair value through net income debt investments, and as it is earned, we would adjust the book value of the investment by the amount of any discount or premium amortization, as we did when we looked at the amortization table a few slides back. The change arising from the adjustment of the investment to its current fair value at each reporting date is recognized as a gain or loss on fair value through net income debt investments. So that would be the case, excuse me. So in the previous example, if the market rate moved from 10% to say 12%, the value of our bond instrument would be going down because we're promising them an 8% return, and they wanted 12% return, which is even more than the 10% return. So all those future cash flows would be less valuable, which means that the value of the instrument would be going down. So the change in value in this case would be recognized in a separate account, such as unrealized gain or loss for fair value through net income investments. So we would record it as a gain or loss, but we would separate it from the gain or loss on the normal amortization of the discount. When the investment is disposed of, the realized gain or loss on disposal is equal to the fair value at the last measurement date and the proceeds of disposal. So, a fair value through net income example. We bought a non-interest bearing treasury bill, which means we purchase it at the present value of its future cash flows. We purchased it on March the 15th. Its maturity date is September the 15th. So that's 6 months later. April, May, June, July, August, September, 6 months. So we paid $19,231 for a $20,000 6-month T-bill, which represents an 8% yield for half the year. So we recorded on the March 15th purchase date, temporary investment in T-bill and cash going out. And then on the September 15th maturity date, we get our cash of $20,000. We record the temporary investment in T-bill going away, and the balancing figure is the investment income or loss. All right. I have a hard time with my slides here. Another example, a company reported on December 31st their investment in various shares at a carrying amount of $193,000, $192,990. The fair value was only $191,200, so that means that they had lost $1,790 of value. So we record at the end of the year the investment income or loss of $1,790 and adjust the fair value through net income investment asset value down by $1,790, which would result in fair value through net income investments in your current assets of $191,200 after making the adjustment. Now, fair value through other comprehensive income. Chapter 4 introduced the concept of other comprehensive income, or OCI. To recap the terms that were associated with OCI, comprehensive income is a change in equity or net assets of an entity during a period from non-owner source transactions and events, so they're not related party transactions. They're actually transactions with an objective third party. So their change in equity or net assets of an entity during a period from non-owner source transactions and events is the total of net income and other comprehensive income. Other comprehensive income is made up of revenues, gains, expenses, and losses that accounting standards say are included in comprehensive income but excluded from net income, and accumulated other comprehensive income is the balance of all the past charges and credits to other comprehensive income to the statement of financial position date. So other comprehensive income is on the income statement. Accumulated other comprehensive income is on the balance sheet as a separate shareholders' equity category. So the fair value through other comprehensive income model. There are two different versions of the fair value through other comprehensive income model. The difference between them relates to how they treat the holding gains and losses once they are realized. The two methods are with recycling or without recycling. Under the fair value through other comprehensive income model with recycling, then when the investments are disposed of and converted to cash or a claim to cash, accounts receivable, notes receivable, the previously unrealized holding gains or losses to the date of disposal are transferred or recycled into net income. Under the fair value of the comprehensive income without recycling, the realized gains and losses do not get recycled to net income, but they're transferred directly into retained earnings. Aside from this, both versions of the fair value through other comprehensive income model are the same. The recycled, as I said before, recycled is the clean surplus approach. So the clean surplus means that everything goes through the income statement before arriving in the retained earnings. Without recycling would be what we used to call dirty surplus, which means that the surplus was not all cleaned through the income statement over time. So the terms in the IFRS standards are recycled or without recycling. All right. So in the past, fair value through other comprehensive income was limited to equity investments in other companies. However, due to recent changes from IFRS 9, it now includes allowing debt instruments to be classified as fair value through other comprehensive income. And the application of the model is as follows, assuming the investment is equity. We start with measurement at acquisition, being the fair value of the investment acquired, or what was given up if it's more reliable. And unlike fair value through net income investments, transaction costs tend to be added to the carrying amount of the investments. So the total cost includes the transaction costs. When the investment is adjusted at the first reporting date, the transaction cost would automatically become part of the holding gain or loss recognized in other comprehensive income. So the carrying amount of each fair value through other comprehensive income investment is adjusted to its fair value at each reporting date, with all of the resulting unrealized holding gains and losses reported in other comprehensive income. So any dividend or interest income earned is reported in net income, because that's a return on the investment, and received in cash or a claim to cash. When the investment is disposed of, there are two versions of how the fair value through other comprehensive model can be applied. So when holding gains and losses are actually realized, with recycling means that the previously unrealized gains and losses to the date of disposal are transferred into net income, and then from there, of course, they fall into retained earnings. Without recycling, the previously unrealized gains and losses to the date of disposal are transferred directly into retained earnings. So losses would be recorded as a decrease in retained earnings, and gains would be an increase in retained earnings. IFRS 9 requires that fair value through other comprehensive income with no recycling. Let's try that again. IFRS 9 requires the use of fair value other comprehensive income with no recycling for investments in shares. So since the focus of this chapter is on IFRS 9, any examples in the textbook adopt this approach. So that means that changes in value of investments in shares go directly into retained earnings, into retained earnings when they're realized. Sorry, I have a bit of a cold or something, so hopefully you can still understand what I'm saying. Dividend income from these share investments is reported directly in net income, and remeasurement gains and losses are recorded in other comprehensive income. So remeasurement means changes in the value of the asset. Under IFRS 9, investments in debt instruments of other entities are accounted for differently. Under IFRS 9, the interest income and amortization of premiums or discounts and any impairment losses are recognized directly in net income. In addition, remeasurement gains and losses recognized through other comprehensive income are subsequently recycled, means run through net income. So remeasurement gains and losses are recognized through recycling. Let me try this again. So remeasurement gains and losses recognized through other comprehensive income are subsequently recycled when the investment is disposed of, which means that when you dispose of the asset, the unrealized gains and losses which had been recorded in other comprehensive income are now moved from other comprehensive income into net income, and from net income into retained earnings. So therefore, the fair value through other comprehensive income with recycling approach is followed under IFRS 9 for debt instruments. With this method, at each reporting date, the company remeasures the bonds at fair value. So given the current market rate, they calculate the present value of the future cash flows and records the gain or loss through other comprehensive income. If a company sells its fair value through other comprehensive income debt securities before maturity, it must de-recognize the investments. So first you have to revalue the investment to fair value. Second, you recognize the sale and gain or loss on sale at that time. And third, you reclassify the accumulated unrealized loss from other comprehensive income into net income. So here's an example. We bought some shares, presumably, in Nova Industries, Campbell Soup, and St. Boniface Pulp for a total cost of $718,550. And so this was the cost at acquisition, which was November the 3rd, 2016. We debit fair value through fair value other comprehensive income investment, so that's an asset. And we record unrealized gain or loss well, I'm not sure that that's true. I think this is probably incorrect. It would be whatever we paid for them, so whatever the cost was. So we wouldn't record the unrealized gain or loss unless we purchased them for zero and they had instantly increased in value. So I think we should probably just have cash here. So let's assume we put in cash. And I'm not sure I have room to put the whole thing in here. There, modified. Excellent. So we purchased them for cash on November the 3rd, 2016. So the carrying amount is shown as $718,550. And on December the 31st, 2016, which I believe is 2 months after we purchased them, the value had gone down to $683,000. Nova Industries is going up, but Columbia Soup and St. Boniface Pulp both went down in value. So a net decrease in value of $35,550. So we're using the fair value through other comprehensive income technique, which means that we're going to record an unrealized gain or loss, in this case a loss, of $35,550, and the fair value of other comprehensive income investments goes down by the change in the value. Pretty straightforward. So the textbook records this example as a debt instrument example. So on July the 1st, 2017, we have interest income. So July 1st presumably is the date of receipt. So not sure where the maybe confusing the examples in the PowerPoints here. Well, let's assume that they've got the numbers correct. So in this case, we received interest income of $43.24, which would be the effective interest change, and the amount of cash we received is $5,000. The fair value, the interest income would be based on the amortization table. So that's the amount of interest we expect based on our opening value of the comprehensive income. So we receive a coupon payment of $5,000. The interest income based on the market rate of interest at purchase was $43.24. So the difference gets applied to the fair value other comprehensive income investment account. Basically, in this case, the value of the debt investment is going down because we're crediting for $676. Then at December 31st, 2017, which is the day before we receive our next coupon payment, we have interest receivable. We haven't actually received it in cash yet, $5,000. Again, we calculate the interest income based on the amortization table, and the value is going down, $703. So we clearly issued this, or we purchased this bond at a premium because we're getting a 5% return, and the interest income is based on something less than 5%. So we bought the bond at a premium. We're amortizing that premium into the value So we bought the fair value other comprehensive income investment. We bought the bond, presumably, at a value in excess of its face value. So we're bringing it down to its face value. So at the date of maturity, the fair value other comprehensive investment account would be equal to the maturity value of the debt instrument. So far the accounting is fairly straightforward. We're using the same method as the amortized cost method. But then we need to account for the remeasurement to fair value. So that would occur if there was a change in the market value of the bond. And so that would be separate from this amortization process that we're using here. So if we assume that at the year end, December 31st, 2017, the date of this entry, the fair value of the bonds is $105,000 and the carrying value is $106,732. Well, that means that we've got a $1,732 decrease in the value of the other comprehensive income investment. So the investment would go down and we'd have an unrealized gain or loss recorded as other comprehensive income. And the carrying value is shown in illustration 9-6 in your textbook. There's an unrealized holding loss of $1,732, and so we report that loss through other comprehensive income and make the entry to change the value. So interest income in both these cases is recorded as part of net income, and the unrealized gain or loss through the change in the market value of the bond would be recorded as other comprehensive income. So, classifications, GAAP classifications. Now the standards in this area are in somewhat of a state of transition. ASPE was approved by the Accounting Standards Board and released in December 2009 and effective January 1st, 2011, and of course earlier adoption was allowed. IFRS 9, Financial Instruments, was released in late 2009 and they're not required to be implemented prior to 2018, though earlier adoption is permitted, and IAS 39 was currently in effect up until 2018. But IFRS 9 is now applicable. So illustration 9-15 in the textbook outlines the differences between ASPE and IFRS when accounting for financial investments. And these would be investments where there's no significant influence or control, because those are covered in Business 401, our Advanced Financial Accounting course. So these are investments, non-strategic investments. Basically, we used to call them portfolio investments. So take a look at illustration 9-15 for the difference between ASPE and IFRS. Most of these issues have been addressed already in our discussion, but this illustration gives you a useful summary. Other issues include the fact that under IFRS, investments measured at amortized cost. Let's run that. For IFRS, investments which are measured at amortized cost. Investments are measured at amortized cost if a portfolio of instruments is managed with the intent to hold on boy, this one's not working at all. Let me review my sentence for a second. Alright, let's try that again. IFRS. Under IFRS, investments are measured at their amortized cost if a portfolio of instruments is managed with the intent to hold on the basis of yield to maturity. So it's we used to call that held to maturity. So investments which are intended to be held to maturity are recorded at amortized cost. Otherwise measurement is at fair value through net income. So the value would be adjusted as the market value adjusts. A special election is available to choose fair value other comprehensive income without recycling for longer-term strategic investments, even though the investor does not have significant influence or control. So you can choose fair value through other comprehensive income without recycling for longer-term strategic investments without significant influence or control. Reclassification is not allowed except in the rare occasion where there's a change in the entity's business model. So if we've actually stated a change in our business model and changed the intent for the underlying investment, we could reclassify it from fair value through other comprehensive income into fair value through net income. Alright, under ASPE though, the cost-based method generally applies for all investments except when they are equity investments that are quoted in an active market or are derivatives of other securities traded in an active market. So we would use the cost method and record actual income received as the dividend or interest income on those investments. ASPE allows entities to choose the fair value through net income model for financial instruments with interest earned and dividends received recognized in net income. If the choice is made for a fair value option, the choice is irrevocable, so it means they can't change their mind later and take it out of their net income. The fair value through other comprehensive income model is not permitted under ASPE. So, looking at the flowchart given here, we start by looking at the instruments which are within the scope of IFRS 9, and then we ask the question, are contractual cash flows solely principal and interest? If so, it's a debt security. So it follows this one. Is it held to collect contractual cash flows only, which means that they're basically holding it to maturity? If yes, then they have to choose the fair value option. If they want to take the fair value option, it falls this way. If they don't want to take the fair value option, they'll just simply calculate the amortization of the discount over time and eventually receive the cash equal to the maturity value of the debt. On the other hand, if they choose the fair value option, they would record fair value through profit or loss, fair value through net income for those securities. Going back up here, if the contractual cash flows are not solely principal and interest, so essentially an equity investment, then you would treat it as fair value through profit and loss. And I think there's a note with this asterisk that says the presentation option for equity investments to present fair value changes in other comprehensive income. So you have the option of changing fair value and recording the fair value changes as part of other comprehensive income, and other income would go through profit and loss. All right, so if it's a debt instrument, but you're planning to sell it sometime in the future, so you're not just holding to collect the coupons and face value when you're done, so it's not something you're holding to maturity, then the answer to this question is no. Then the question is it held to collect the contractual cash flows and for sale? If it's I'm not quite sure, that should take us back to this column. So if it is held to collect the contractual cash flows and for sale, so they're planning to sell it sometime in the future, then they're considering the fair value option, and so the fair value would be, if the fair value is chosen, they're back over here, which essentially I think means that our cash flow put us back over here again. And then if we choose to take the fair value option, it would be fair value through other comprehensive income. I'm not sure that this flowchart helps us a great deal with our decision making, but a quick review. If we've got a financial instrument that fits the categories in IFRS 9, first thing we need to assess is, are we planning to hold it to maturity? If we are planning to hold it to maturity, then are we just planning to receive the cash flows only? Well, let's start this again. Boy, this is a bit of a confusing flowchart, and my eyes aren't good enough to see the small writing on my screen. So, financial instruments. First question: is it a debt instrument or an equity instrument? It depends on whether the contractual cash flows are just principal and interest. If they include a participation in earnings, then of course it's an equity instrument. In which case, fair value through profit and loss with a potential exclusion of fair value changes through other comprehensive income. Okay, if it's purely a debt instrument, then the question is, are we planning to sell it sometime in the future or not? If we're not planning to sell it sometime in the future and just collect those cash flows, then we have to choose the fair value option. We can choose to record it as amortized cost, which is the same as ASPE, or we can choose the fair value through profit and loss, which means that we revalue the security from time to time, and changes in the fair value would be recorded as other comprehensive income. Income received, the same way as amortized cost, would be recorded as net income. On the other hand, we're holding it with the potential to trade it or to sell it sometime in the future. If we are holding it to collect contractual cash flows and for sale, then the answer is yes, we have to choose the fair value option of either fair value through profit and loss or fair value through other comprehensive income. So this would be the changes in value. Because we're holding it for sale, the change in value would be relevant. Okay, not sure that flowchart helps me a lot, but hopefully it made some sense in our discussion. Impairments. What happens if the value of the share or debt instrument goes down? Well, review for impairment is generally only applicable to investments valued at cost or amortized cost, because fair value investments would automatically reflect any impairment because they're recorded at fair value. Both IFRS and ASPE require entities to adjust for impairment at each reporting date, preferably on an individual investment basis, unless doing so would not be timely, in which case investment portfolios with similar characteristics could be grouped and assessed together. Impairments on investments are recognized when there's no longer reasonable assurance that the future cash flows associated with them will be either collected in their entirety or when due. So impairments are a result of a reduction in cash flows expected. 3 models could be used to calculate and record the losses, as the ones listed here show. A loss assessed under all models would be recognized in net income, and reversals would generally be permitted up to the original amortized cost calculation, though there are some limits on reversals. So these models are the incurred loss model, the expected loss model, and the fair value loss model. So looking at investment risk, credit risk, is there a significant increase in the credit risk? If so, yes. We consider the risk of default over the life of the investment. Are we likely to get defaulted on? Then we estimate the lifetime credit losses, considering the probability of default over the life of the investment, and that would be reflected in our accounting for it. If we decide there's not a significant increase in credit risk, then we would consider the risk of default in the next 12 months and estimate the lifetime credit losses considering the probability of default over the following 12-month period. So what that's saying is if there is a significant increase in credit risk, we have to assess the entire life of the instrument. If there's not a significant increase in credit risk generally, then we would only need to consider it for the next 12 months. All right. This is going a little slower than I was expecting it to, so hopefully it speeds up here in a bit. The incurred loss model. Under ASPE, the incurred loss model is applied using the current discount rate. Under IFRS, the existing standards use a combination of the incurred loss model using the original discount rate and a fair value model, and the impairment losses may be reversed. IASB is also working toward a new model for impairments and has proposed the use of the expected loss approach, where investments are divided into 3 categories for impairment assessment. These categories are general, group, or portfolio of investments with similar risk, and individual investment. So general, or portfolio, or individual investments. Take a look at illustration 9-14 in the text, which provides a summary of the impairment models, and illustration 9-15 provides a summary of how to account for them under ASPE and IFRS. So we would test on an annual basis whether there's evidence of possible impairment, and indicators of possible impairment would include things like the company's having significant financial difficulties, they're defaulting on their payment promises, there's a major financial reorganization or a statement of bankruptcy received from the bankruptcy lawyer. So we would record the impairment loss in net income as the difference between the carrying value and the revised present value of the expected cash flows, and the revised present value would be calculated using time value of money principles, discounted cash flow using either the historic or current market rate as the discount rate. The expected loss model. Under the expected loss model, estimates of future cash flows would be used to determine the present value of the investment, and those estimates would be made on a continuous basis and don't look for a particular triggering event to occur. So you're expected to do this assessment every time you do a valuation. These revised expected cash flows are generally discounted at the same effective interest rate used when the instrument was first acquired, therefore retaining a cost-based measurement. So we're essentially using the same discount rate. Estimates of impairment losses are based on reasonably available information that is obtainable without undue cost or effort. And under this approach, almost all financial assets will need to be assessed to determine if there might be expected losses. Illustration 9-16 in the text contains a decision tree summarizing this expected loss impairment model approach. Fair value loss model. Under the fair value loss impairment model, the impairment loss is the difference between the asset's fair value and its current carrying amount. Assuming the fair value is less than the carrying amount, fair value is calculated using all the current information, including revised cash flows, current interest rates, and market values, and investments valued using fair value through net income. There's no need to do a separate impairment test because it's already including changes in fair value in income. And illustration 9-17 summarizes the various impairment models under ASPE and IFRS. So you would use the current interest rate. That's the main difference between the fair value loss and the expected loss models. So IFRS currently uses the expected loss model using the original discount rate, and for fair value through net income investments and equity investments accounted for under fair value through other comprehensive income, we would use the full fair value model, which means we would use current interest or current discount rates to assess the cash flows. There's no need to do a separate impairment test for fair value through net income because we're already accounting for changes in the fair value. ASPE. Under ASPE, you would use an incurred loss model using the current market rate, and so that would be for financial investments accounted for using cost or amortized cost. For equity instruments with market values and then derivative instruments, we'd use the fair value. So presumably the fair value is determinable through objective, publicly available information. Strategic investments. Strategic investments are classified as either significant influence investments or control investments. Significant influence means that you can influence the timing, but you don't have absolute control. Control means that you can actually make choices regarding operating, financing, and investing decisions of the investee. So little or no influence would be the ones we've talked about already, the non-strategic investments. Significant influence is where you can influence but not control, and control is control. In general, we can start by talking about the degree of ownership interest as an initial indicator of control. The degree to which one corporation, the investor, acquires an interest in the common shares of another corporation, the investee, generally determines the accounting treatment for the investment subsequent to investment, or to the acquisition of the investment. Investments by one corporation in the common shares of another, and the accounting method to be used can be classified according to the percentage of the voting shares of the investee held by the investor. However, this is only a guideline, and other factors would need to be considered as well. So we sort of start with the ownership interest as our beginning assessment, and then we adjust for other extenuating circumstances. So in general, less than 20% we would use the fair value method as we discussed today, because there's little or no influence. So imagine you bought 100 shares of IBM. You don't have any influence over the activities of IBM. So in that case, you would use the fair value method. If it's between 20 and 50%, we assume significant interest unless there's some indicator of that. So if you own 20% and somebody else owns the other 80%, chances are you're not going to get them to do very much. So you might actually determine at that point you don't have really significant influence, and you might actually treat it as a fair value non-strategic investment. If it's more than 50%, we presume that the investor has controlling interest, but it may be reduced through things like committed contracts at a potentially harmful or potentially unprofitable rate. So you may not actually have control over the subsequent company. If there's a significant supplier or a significant customer of that company, the customer's relationship might actually indicate a limitation in control. I won't get into this too much because we're going to talk about this in a lot of detail in Business 401. But essentially, we start with the degree of ownership and then adjust for other things. So other factors in addition to the percentage ownership would include representation on the board of directors, participation in policy making, material intercompany transactions, such as I said, could be commitment at an unprofitable rate of exchange, Interchange of management personnel, so if it's the same managers working in both companies, that's probably an indicator of more control than otherwise. Or provision of technical information, so if they're using your technical processes, if you take away those technical processes, then you could control the company through that process as well. So we sort of start with the amount of ownership and classify it into these three areas based on that. And then we would adjust for the extenuating circumstances as we've discussed. Okay, let's move on to the next slide if we can. So investment in associates or significantly influenced investments use the equity method, and the equity method refers to the fact that we actually record our share of the income of the earnings of the significantly influenced associate company. So we don't have control, so we can't tell them when they have to pay us. But the reason we would use the equity method as opposed to just the cost method is that we can actually influence the timing of dividend payments. So if we were to treat it as a cost investment, we could actually influence the timing of receipt of income into periods in which we want to get lots of income, and out of periods in which we don't want a lot of income. And so the equity method recognizes the influence we have and says that we have to record our share of the earnings of the associate, whether or not we actually receive them. So we can't control the timing and bias the financial statement results. So we start with the test of ownership. 20% to 50% is presumably significant influence, and then we would assume if there's more on the qualitative list, that would tend to influence, increase the influence. If we've got a majority on the board of directors, even if we've got less than 50% ownership, that might indicate control, for example. So when the investor can exercise significant influence over operating and financial policies of the investee company, they're considered to have significant influence, and the investor is required to account for the investment using the equity method, which we'll discuss at length in 401. Under the equity method, the investor in the investment's carrying amount is periodically increased or decreased by the investor's proportionate share of the earnings or losses of the investee, and decreased by all the dividends received by the investor from the investee. So when they make money, they owe us that money. When they pay us that money, they don't owe us the money anymore. The adjustments made to the carrying amount will also result in increases or decreases to investment income, whether or not we actually receive it from them in cash. They owe us the money, so it's going to increase the value of our asset if they're making money in the associate company. When the investment was originally purchased, the difference between the carrying amount of the company being purchased and the actual amount paid is allocated to the appropriate assets and liabilities purchased. So we figure out how much. If we buy the company for $1 million, we figure out if we own 40% of the company and they've got a certain amount of assets, we would record our proportionate share of those assets, a certain amount of the liabilities. But all of this would be recorded in a one-liner on the balance sheet, and a one-liner on the income statement would reflect all of the net impact of the earnings of the associate company. So we do the allocation in the first case when we bought the asset, and so that could include tangible assets such as inventory, or intangible assets such as patents, or unrecorded assets such as a customer base or supplier list. Any excess amount that can't be allocated to an identifiable tangible or intangible asset or liability would be allocated to goodwill, because we're buying another company and it's an objective transaction. So presumably at that time we're actually paying cash to buy this amorphous thing called goodwill, which we're not really sure what it is, but it's a reason to pay more than the value of the assets. The subsequent accounting for the excess fair value or goodwill follows accounting procedures that would normally be followed for those assets. So inventory would be amortized usually in the same way that the associate company is doing that. But goodwill would be assessed and determined every year. We'd have to check to see whether goodwill is actually impaired. If it's impaired, we write it down, and if it's not impaired, we leave it at that value. We used to amortize goodwill over a period of no more than 50 years back in the day, but the UK and the US never did. So we had this extra charge on our balance sheet, or this extra charge on our income statement that competing firms in the UK and the US didn't ever have. So we always had worse numbers than they did. So managers didn't like that. They lobbied the standard setters, and the standard setters, okay, we can just use an impairment test for our goodwill the same way the UK and the US does. And so it's no longer a difference. So if we're looking at the company called Maxi Limited here, the Maxi is using the equity method, and so Maxi purchased 20% of Minicorp, and so they think they exercised significant influence over Minicorp's transactions. On January the 2nd, 2016, they purchased 48,000 shares at $10 per share, so about $480,000. In the year 2016, Minicorp reported an income of $200,000, so their share is $40,000. The influencer, Maxi Corp, the parent company, is due $40,000. And on December 31st, 2016, the shares of Minicorp has a market value of $12 per share, which means we made $2 per share. On January 28th, 2017, they declared and paid a total cash dividend of $100,000, so we got $20,000 from that because we own 20% of the shares. And the 2017 year, they had a net loss of $50,000. So we need to record all of these things using the equity method. On January the 2nd, 2016, we bought the shares, and that's indicated by this first transaction. Then on December 31st, 2016, we record our share of the income. So we record investment income under equity and record an increase in the investment in Minicorp. So one line on the balance sheet, investment in Minicorp, one line on the income statement, investment income. On December 31st, 2016, we don't have to make any entry to reflect the fair value change because the investment is not impaired. So it's going up in value. We don't record that market value change in the equity method. In 2018, we received a dividend, so they no longer owe us the money. We've actually received the money, so we get the cash, record a decrease in the investment in Minicorp. So we get basically our share, or part of our share, of the investment income from December 31st, 2016. Then in investment loss, December 31st, 2017, the Minicorp had a $50,000 net loss. Our share is 20%, which means that the value of our investment goes down by $10,000, and we recorded an investment loss of $10,000. So, other things that we need to think about for the equity method: if there are discontinued operations and other comprehensive income in the associate company, we would report them the same way in the parent company's books, and so we would record them as they were recorded by the subsidiary company. Impairment: under both IFRS and ASPE, impairments in value are assessed at each statement of financial position date, and a loss would be recorded if the carrying amount is more than the investment's recoverable amount, and that loss may be reversed if future events indicate that the recoverable amount has been improved. You wouldn't be able to increase the value above the initial carrying amount. On the disposal of an investment in an associate, the investment account and the investment account and the balance sheet account and the income account would be brought up to date as of the date of sale. So you would record the associate's income up to the date of the sale, and then that investment carrying amount would be used to calculate the recording of gain or loss on the sale. That way you would be treating investment income properly in its character as investment income, and the amount of the gain or loss on sale would be treated properly as a gain or loss on sale. Investments in subsidiaries require consolidation, so here you would presumably have ownership of more than 50% or some other indication of controlling a controlling position. So when one company, the parent, acquires a voting interest of more than 50% in another corporation, the subsidiary, the investor corporation is deemed to have a controlling interest. And when the parent treats the subsidiary as an investment, consolidated financial statements are generally prepared instead of separate financial statements for the parent and the subsidiary. So the parent and the subsidiary if the parent and the subsidiary prepare separate financial statements, the investment in the common shares of the subsidiary is presented as a long-term investment, on the financial statements of the parent under the equity method. The equity method is sometimes called one-line consolidation because there's one line on the income statement and one line on the balance sheet. The results for net income and retained earnings would be the same whether financial statements are actually prepared using the equity method or prepared using the consolidation method. It's just the disclosure on the income statement, and the balance sheet would not include all of the details of the individual assets and liabilities and individual components of income under the consolidation method. The subject of when and how to prepare consolidated financial statements is discussed extensively in our advanced accounting course, so we'll leave it for that. Under IFRS, investments in subsidiaries should be accounted for by consolidation, so we essentially add all of the businesses' assets and liabilities together in the consolidated statement and reflect the fact of our liability to minority interest as part of the consolidation process, and we would also record all of the 100% of the assets available. Under ASPE, the parent company could consolidate the subsidiaries or just account for them under the equity or cost method. There's a note here that says that the cost method can't be used if the shares are traded at active market, so you would have to use fair value through net income instead. So changes in value of the shares would be adjusted to the value on the balance sheet. Consolidated financial statements basically add all of the parent companies and subsidiary companies' assets together. If there are any intercompany balances between the companies, so the parent company owes the subsidiary money, of course you can't owe money to yourself, so that would be offset. The accounts receivable would be offset by the accounts payable, and so we would eliminate any of those intercompany balances. Any unrealized intercompany gains and losses through sales between the companies, which hadn't actually been sold to a third party outside the entity, would be undone as well, and that gets really tricky, so that's why it's an advanced financial accounting course. The parent would be on their own individual books would record an asset called investment in subsidiary, and of course that investment in subsidiary would be allocated to all of the assets of the subsidiary upon consolidation, so the investment in the subsidiary company goes away because you can't have an investment in yourself, and you're adding all of these two entities together to be one entity, so you would remove that investment in your subsidiary company. And then of course what you owe to the non-controlling interest would be reported separately. So that would be, if you, for example, if you own 60% of the subsidiary corporation and there's somebody else who owns 40%, that would be the non-controlling interest, that 40%. They have a 40% interest in the income of the company, and so you have essentially a liability to pay them their share, or they'll sue you, and bad things will happen. Presentation and disclosure, kind of a final wrap up here. Investments. The investments account, presentation and disclosure are fairly similar between IFRS and ASPE, with some differences, but generally current investments would be classified under IFRS. If it's expected to be sold or otherwise realized with the entity's normal operating cycle or within 12 months, we would call it held primarily for trading. Let's try this again. Under IFRS, if it's expected to be sold or otherwise realized with the entity's normal operating cycle or within 12 months from the balance sheet date, it would be recorded as a current asset. If it's held primarily for trading, it would be treated as a current asset. Or if it's a cash equivalent, such as government T-bills, it would be treated as a current asset. Under ASPE, if it's usually realizable within 12 months from the statement of financial position date, or the operating cycle if it's longer than 12 months, and it can be readily converted into cash, it would be treated as a current asset. Current assets could include debt and equity instruments measured at cost or amortized cost, and those at fair value through net income. Disclosure. Under both IFRS and ASPE, the carrying amount of the investments and the method used need to be disclosed. Net gains or losses recognized by the method of accounting, interest income, impairment losses, and reversals would need to be disclosed separately. Under IFRS, you would need to provide quantitative measures of risk exposures and concentrations and information on how management manages those risks. Non-current assets would include investments held at cost or amortized cost, or fair value through net income if they don't meet the requirement to be classified as current. Fair value through other comprehensive income investments, as they're usually held for long-term strategic purposes, would be non-current assets. Investment in associates, unless they're held for sale, the income would be reported as income before discontinued operations. Discontinued operations would be shown separately. Or other comprehensive income would be shown separately according to its nature in the associates' financial statements. Disclosures for associates accounted for under the equity method would include disclosure of the investment category, the method of accounting used, fair value of any of these investments if they have an active market, separate disclosure of the income from investments under the equity method, and information about the associates' year's ends if they're different from the investors' year ends. Calculations that we would use for analyzing these intercompany investments would require disclosure that makes it possible for the reader to assess investment results from operating results separately. So you should be able to calculate your return on investment through changes in fair value, so capital gains versus dividend and coupon returns. You need to be able to understand the relationship between the investment asset and its related returns, so you can calculate return on investment on the income side, and the effective accounting methods which are used, such as consolidation or equity methods. IFRS versus ASPE are discussed in illustration 9-24 in the text, and we'll be covering a lot of the topics in this chapter separately in Business 401, the Advanced Financial Accounting course, and that's it for Chapter 9 in this course.